Good morning, everybody, and welcome. This is Pete Swisher at Pentegra Retirement Services with our Tales of 401k Administration Gone Awry. And I guess a little bit about what we're doing before we get started in full. I will give a minute or so for others to join. And while we're waiting, I'll start with a little story. I had a lunch yesterday with an old friend of mine, and he's a financial advisor, been in the business many years, and he was complaining. He was complaining about how a couple of his clients have a third-party administrator or have had third-party administrators over the years, and that whenever things go wrong, the third-party administrator is always looking to blame the client. It's always my client's fault. And I thought about that, and I think that what we know in the industry, what we know in the financial services industry generally, but in the 401k specifically, those of us who do this for a living know that when something goes wrong with a qualified plan, it is in fact usually the client's fault. So I'm gonna pause for a second and give some perspective on what I'm saying here. So we have on the line today a number of plan sponsors, including some current clients. Thank you all for being here. We have some of our own folks, some professional administrators. Pentegra is a professional independent administrator. And we have a number of financial advisors. So you're probably looking at this going, wait a minute. But you know what? It's true. If you talk to ERISA attorneys, you talk to people who do this for a living, you say, oh yeah, it's usually the client's fault. Well, here's the other thing that I think that maybe should be realized a little bit better is that when we say this, even though it's true, clients do not find this helpful. Clients are not appreciative of the fact that, yeah, okay, maybe I'm the one who screwed it up. Could you maybe help me not screw it up? And so a big part of the perspective I hope to give you in the next 28 minutes is that, yes, a lot of things that go wrong are the client's fault, but why is that? It's because we put the client at the middle. So one of the themes today is that there are chores that you keep by virtue of the way that you arrange your plan. You can keep more chores, you can self-administer your plan, or you can keep fewer chores. You can hire professional fiduciaries and outsource stuff. And there are degrees in the middle. You know, some vendors accept more, some less. But the point is that, of course, if we leave the bulk of the duties as the legal responsibility of the client, anything that goes wrong, yeah, it's probably going to point back to the client. But again, that's just not helpful. So what I hope to leave you with today is what do you do about this? So I'm going to do it through talking through things that go wrong and giving you some perspective on then how do you make it right? How do you make sure that you as an employer get it right? And that is our target today. So we have an audience of a bunch of different folks. This is really for you as an employer. How do you get your plan set up right? And we'll start with, you know, what is the job? What are the duties? The plan administrator is one of the two key fiduciaries who run a retirement plan. The other is the trustee. So the trustee is responsible for the assets, and the administrator is responsible for everything else. And the everything else is a lot. A plan, a qualified plan, a 403B, a 401k, whatever, is, if you look at what it actually is, it is a legal document. It's a 140-page legal document. And the word administrator appears in that document something like 300 times, and it says you're supposed to do stuff. And when you're the administrator, when you haven't appointed a professional independent administrator, then it's you who is responsible for these chores. And there's an implied burden to know something about them. You know, you don't have to be an expert. You have people helping you. You know, you've hired vendors, but you do need to know something about it. More importantly, you need to know what it is you're supposed to do and know when you're required to intervene, to approve, to make a decision about something. So that's the starting point.
Good morning, Pete. Sorry to interrupt you. This is Beth. I just want to make sure that you have your screen sharing on for us to see. I didn't know if you had that on.
Thank you, Beth. This is the second time you have had to do this with me. One moment. Sorry, everybody. My button clicking skills not up to speed. Yeah, we had it on the wrong presenter, Beth.
Sorry about that.
That's all right. All right, nothing lost here. Okay, sorry everybody. So let's talk about uh, how do you set up your plan? What are the things that can go wrong? And yeah, it might be your fault today. How do we not make it your fault tomorrow? And this is the slide I was on, the 50 chores of the plan administrator. And let's start with some of the easiest stuff that tends to get missed. Um, one of them is just the plan document. So this 140-page legal document that you're supposed to keep up to date uh, actually gets out of date all the time. So for whatever reason, this is the #1 most common voluntary correction program filing with the IRS. So it's something that clients somehow screw up. And it's really not hard to keep right because any retirement plan vendor will help with this. So what happens is it's because the client is stuck in the middle of it, they're supposed to do something. They're supposed to approve it, sign it, send it, and it just doesn't get done. And so a very common failure and a very simple one. Another one is the 5500 itself. This is a big deal. There's a very stiff penalty for not submitting the 5500, and yet it happens all the time. There are something like 25,000 Department of Labor filings using their DFECP program to correct for this one. So a very common error, and again, a very easy one that usually is not going to go wrong if you have a good vendor, but for whatever reason, does get missed quite a bit. So let's go through some specific situations that things go wrong. I had a client, and this is some years ago, but she was a new jack of all trades executive for a company with about 250 employees. So she was a combination CFO, payroll, office manager, you name it, and but didn't have a lot of experience with retirement plans. Had experience in other areas, but not retirement plans. So the idea at their company was benefits have 90-day eligibility, which was accurate. On the healthcare side, the entry into all of this was after 90 days. So the day after the 90th day, you could start to have healthcare coverage. And that was true for all of their benefits. But we have this concept in retirement plans called an entry date. So an entry date is the day on which you enter the plan after you become eligible. So the equivalent of her benefits eligibility would have been what we call immediate entry, but that isn't what her plan document said. Her plan document called for first of the month entry. So in other words, someone could be employed 90 days and the 90th day falls on the first of the month. Well, that person's not going to enter the plan until the first of the following month. So, but she was letting everybody in as if it were immediate entry. That's wrong. And even though it's kind of giving a benefit too early instead of too late, still an error that the IRS makes you fix. And it was frustrating. And that client had a number of other errors that were going on when I came on, when we were hired to try to help clean that up. So it was a frustrating one. Another problem that happened recently. So this is an example of how difficult the payroll function can be. So one of the most important things you get left with, no matter how much you outsource, no matter how few chores you choose to keep with respect to your plan, you still got to do the payroll. So we'll talk a little bit more about that as we go along. But in this case, the record keeper, and we work with a number of different record keeping platforms. The record keeper and we and the client had a conversation when we were first setting up the client. Here's how the payroll file needs to be set up. We need a full payroll file. We need all this information every pay period. That'll help with the administration in a variety of ways. So here are the data fields we need. Somehow that went off track. Everybody seemed to be on the same page, but the client went back and ended up in conversation with the record keeper, setting up a pay file that only included employees who are actually contributing to the plan. Now that is a normal thing. So in the industry, this is actually the way it's normally done. The record keeper typically only cares about who's sending money because they need to post the money. The administrative work is largely done at year end via an annual census. So it's kind of normal not to set up a full payroll file. If you want help and if you want data that will help you get reports that'll do good administration, you need to send a full pay file. So anyway, the problem in this case was this customer had a lot of turnover and there were new employees all the time and they had automatic enrollment. Well, 6 months went by, we didn't notice anybody coming in, and we called the client and said, I thought you had a lot of new hires. And the client said, yeah, but they hadn't been auto enrolled. And it was because no one had any visibility that these new hires existed in order to get them set up in the plan. And of course, there are corrections associated with this. This one perhaps is a little bit of an extreme example. We sometimes have these situations where the client will say, "I thought you did all that stuff." And in our defense as an industry and for our salespeople, I think our salespeople, I'd like to think, are very good at not overstating what we do and don't do. But clients get an impression, and you're going to leave this webinar and you're not going to remember more than about 5% of what I say, truly. But you're going to get an impression. So clients get this impression of, oh, thank goodness, I'm going to have this stuff come off my plate, and they think, okay, I'm going to be out. I'm not going to have to do anything. For whatever reason, this particular client thought, I literally don't have to do anything. They weren't even submitting payroll. They weren't sending contributions. I don't know. You got to wonder what they were thinking. Like that this company is going to reach into my client, my employee's personal info, and into my bank account without some sort of a setup process and some approvals. But literally, they said, "Oh, the salesperson said we didn't have to do anything." So even though that is an extreme example, this is the kind of thing that happens. It does happen. This one was a while ago. This was another one where a client was going through a difficult period because they had multiple corrections. They had been audited by the IRS. The IRS found a number of things wrong. This was just one of them. This was painful because it really hurt the participant. There was an employee, long-term employee, who took out a loan, and she, of course, she knows I'm going to repay it. It's to my own account. But there's a certain expectation that goes with that. Well, there were no repayments taken out of payroll for a little over 2 years, and it was discovered on audit, and this was just plan audit, the regular annual plan audit. And unfortunately, there's not an easy correction for this. So the employee's faced with a tax penalty, and the employer's trying to figure out what to do. Ended up writing a check. Ended up stepping up to help the participant. But this is somebody now who's faced with, even if it's correctable, 2 years worth of back payments, which just simply wasn't possible. And it's just because it wasn't noticed, it wasn't put into the payroll system, and nobody caught it until a couple years later. Another one that I'm hearing a lot recently, so it has become more common, even though the norm historically in the industry has been to say, you don't have to give us a full payroll, and you don't have to send us anything other than the employees who are making contributions. So that is historically kind of normal. But more and more, vendors are recognizing the benefits of having a full payroll file. We get good data on where people live, so we can send them notices. We get good information on whether they're vested or not, so we can do automated distributions. So it's good that there's a growing recognition. And the sales pitch that has evolved is that you won't have to do the end of year census. So we had one client who hated doing the end of year census, just hated that whole process, which I don't blame anyone for. And the salesperson said, "Hey, when you get it set up to do this full pay file, now we're going to have all your data during the year, and that means we're going to have everything at year end. You won't have to do the census." That is false. It is absolutely false. If there were a way to make it true, we would make it true. There are all kinds of reasons why you actually have to verify the census and why it will not match what you sent during the year. And you shouldn't get upset about that. We sometimes have clients get upset. Why doesn't the data you have match what I have? It actually does. It's just that there is end of year stuff that your accountant does for you that creates the true W-2 or whatever compensation that has to be reconciled with the data that's actually been submitted during the year. And so part of the cure is you just sort of have to understand that. And one of the chores you can't get rid of is you do have to do, if not recreate the whole census, you do have to verify the census, and you do have to supply missing data. And I'll give an example in a minute of what might be missing. So in this case, the client didn't do the end of year census because they had been told they didn't need to. Things were wrong and there were corrections. And here's an example of how that works. So PENTegra likes to use W-2 compensation because it's simple. Everybody understands it. W-2, what could be more straightforward? Well, I wish it were straightforward. It's actually not. Because as an example, if you look at box 10 or whatever it is where you get W-2 compensation, it's gonna reflect that the deferrals and cafeteria plan deductions, it's not going to be in that number because the employee's not paying tax on that number. So when we define compensation for purposes of the plan, it's usually W-2 adding back in the deferrals and cafeteria plan stuff. But it's even not that simple. There are other types of compensation that are reportable for W-2 purposes, but because they're not cash, they never get put in until the end of the year, or at least they rarely get put in until the end of the year. And it raises this question of, do you match on that stuff? Like, for example, if you gave somebody a moving allowance, or if they had some sort of a gift that had to be reported taxably, are you supposed to do a matching contribution on that? Well, that depends on what your document says. So there are ways that can go wrong, and this stuff has to be reconciled at the end of the year. Another thing that we get with the end of year reconciliation is the bonuses. So some companies like to pay a holiday bonus, and we've had clients where they don't want to see any deductions from those bonuses. Well, a couple problems with that. One is, what does the document actually say? Does it say that employees are allowed to do deferrals based on their bonuses? Because then you're supposed to give them the option. But then how do you do that? Do you have a form for it? It gets overlooked a lot. But typically the company doesn't want to have people see deductions from their bonus. They want them to see the whole thing. Well, the problem is, if there's no deferral contribution, the client's typically not uploading a payroll. There were no 401k contributions, don't need to submit the payroll. And so here's an entire payroll with compensation that counts in the definition in the W-2 comp, and it's not going to be in our system unless it's been uploaded. So there's, again, the end of year verification, and that can create a number of problems when that information is not in there. Another type of problem related to that, participation compensation. So very common for an employer to say, we don't want to count the period of time when this new employee was not a participant in the plan for purposes of determining contributions and testing and so on. And that's a normal, smart thing to do. The problem is when you download your end of year census, the payroll system doesn't know any better than to just give the full year W-2 compensation. And so participation compensation is a different thing. And there's not any automated way to handle this. You kind of have to go back person by person and say, Tom, Sue, and Harry were hired during the year on these dates. We need the compensation for that portion of the year, and then we can true everything up. But it's a manual thing, and that's okay. You just have to be aware of doing it. And the point that I'd make about this is that, especially with small employers want affordable solutions. And so what does that mean? It means automated solutions. So if you're buying an inexpensive solution, it's going to have less labor attached to it. And that means fewer people checking behind you. You're self-administering by renting someone's software, basically, someone else's system. And that's okay if you know how to use it. But this is an issue where what that vendor is likely to do is simply accept whatever data you upload. They're not going to look for this sort of thing. It's just whatever the data is when the button gets hit to do the testing, that's the data that will get used. But that is going to lead to a lot of problems. And so that is a source of a lot of corrections in our industry. Last few examples we have, and I think I go up to 11, and I'll start winding down here. I've had a couple situations where the plan document says one thing, but the client says, "Oh no, we don't do it that way," which is a problem. So we have a plan document call when we first bring on a new client. We'll ask the question, "Hey, your plan says 90 days eligibility, first a month entry. Is that what you actually do?" That's how we discovered the example that I gave earlier. And so lots of ways this could go wrong. We had one client where somewhere along the line, bonuses for salespeople had been excluded, and that got changed to where they were included, but the client continued doing it the old way. They said, "Hey, we've always done it that way." Well, the document didn't say so, and that created a lot of problems. And there were checks that client had to write, and they were very unhappy. Another example is where you've got a document that calls for payroll match. Had clients, a number of clients do this for the final payroll of an employee who has quit. They don't want to make the matching contribution. It's a normal thought to have, but it's not permissible because the plan document doesn't permit it. So again, this is one that got discovered, and there was a payment involved that made the employer fairly unhappy. I've had a number of clients that you could characterize probably as a bloody mess. And by the way, these messes tend to occur when we first pick up a client. They tend to not occur thereafter. That doesn't mean there are no problems. There are always things that go wrong. So these little foibles of payroll and data and talking back and forth and a new payroll administrator learning his or her job, they're inevitably going to be some some labor and some effort, but not this kind of a bloody mess, so to speak. But I've seen this in this particular case, a client, different client, not reporting salesperson commissions, and it just led to a whole series of failures. And on top of that, they had put in auto enrollment, but they hadn't actually auto enrolled anybody. In other words, somebody doesn't make an affirmative choice to take money out of their paycheck for the 401k. But if they don't tell us one way or the other, we just put them in. It's called auto enrollment. Well, if you fail to auto enroll somebody in a plan where you're supposed to, there can be a big payment for that. And this client was faced with a $500,000 bill. Would have put them out of business. They had to get a lawyer and sort through it and figure it out. So we got them sorted out, but this is not an uncommon story in the industry. Another very common thing that we see, there's this concept of dual eligibility. And this is an example of a plan provision that creates manual labor that is likely to be done wrong. And so you might say to yourself, oh, well, I just won't do that. And that is in fact what we recommend. Don't do dual eligibility because it helps you do it right. But there's good reason for doing dual eligibility. What it means is that you might make somebody eligible to put their own money into the plan today through deferrals, but the match is later. They're not eligible for the match until after 1 year. There are really good reasons to do that as an employer. The problem is the vendor systems out there typically today are able to offer some sort of eligibility management. And the way it gets sold is you no longer have to worry about your new hires. Our system handles that. But I can tell you folks, there are all kinds of holes in that. This is an autopilot. Autopilot doesn't mean no pilot. It just means that certain aspects of flying the plane, it's okay to take your hands off the stick for a minute. But you don't want that plane in the air with no pilot. But that's kind of the way it gets sold, or at least understood by the client. Oh, I don't have to worry about new hires anymore. Well, yeah, you kind of do. That system is not going to handle non-statutory exclusions. You know how to handle that. That system is, and in this case, not going to tell you when you need to put someone in for the match. So we had a problem, have had problems with more than one, where clients came to us and they hadn't been giving match on new employees who had passed the 1 year mark and they had to go back and make the correction. Doesn't necessarily mean a drastic problem, but it is a problem. It has to be fixed. And the client wants to know. They want to be notified, but it's a manual thing. Okay, last couple here. Couple painful events for some clients in the past where they were writing checks. And remember, the theme here is these are duties of the plan administrator. So if you're listed as the plan administrator in the document, and it usually would be your company that would be named, but that means that one or more individuals have the fiduciary responsibility of being the administrator. So if your company is named and this is your role, this falls to you. And in the first example, there was an employee, or in this case, former employee, had gotten divorced. And so there's a domestic relations order from a court. Turned out to not be in good order and not to be qualified such that it is a qualified domestic relations order. Well, you're not allowed to distribute money from a plan other than for a qualified DRO. And in this case, they didn't know that. They had this court order. They followed it. It was a doctor group. The doctor who was in charge wrote a check or authorized a distribution from the plan and ended up writing a personal check for tens of thousands of dollars because couldn't get the money back and it was distributed in error. In another case, unfortunately, all too common, you get somebody who's been divorced and remarried, children of the first marriage named as beneficiaries. Well, there's a rule that you have to have consent, spousal consent, for if anyone but the spouse is going to be the beneficiary, and it has to be notarized or recognized by a plan official, like the plan administrator at the client or the plan sponsor. and it wasn't done. So here we had children named as beneficiary. The person who was at the company who was in charge of this authorized the distributions to the children, and the wife sued, and there were lots of problems around that. So these are things that you get rid of if you hire a professional administrator, but there are also some things that you can't get rid of, right? So let's talk about the cure. Let's talk about what do you do about this stuff. And there are a couple things you can do. Design your plan well. So I mentioned earlier about dual eligibility. With dual eligibility, you create this manual situation. That's okay if somebody's flying the plane, but it's not okay if you're trying to automate things. So you just have to balance that. So design your plan intelligently to avoid plan provisions that create manual work or high levels of expertise required or difficult payroll situations. Just avoid stuff that's going to create problems is step one. Step two, hire a professional independent administrator. Let someone else fly the plane. And number three, you still need a willing client. So we would love to get our clients out of the middle of the administrative burden. We feel like we get them very far out of the middle, but there is no getting around that you're still going to have some chores to do. So let me try to make that a little more specific. So let me draw a little bit of a picture here. So what do we mean by when we talk about these three things that we can do? What does this actually do to help? And I'm going to select my pen. So if this is the universe of problems that we can have up here, we could say that there's some portion of them that we can get rid of just through plan design. So if we use a smart plan design, we're going to eliminate a lot of problems. And then there are a bunch more problems that we can say by having a professional independent administrator, what we call an ERISA 316 administrator. ERISA Section 316 is just the definition of the plan administrator, the person who's responsible for administering the plan in accordance with its terms. And that is what Pentegra does for a living. It's what we've always done. So when the 50 chores are our problem instead of yours, we get rid of this block of stuff. Oh, there's still this. This is you. This is the employer. This is our abbreviation for employer. And so what are the chores that you're left with? So we can get rid of a lot of problems with good design. We can get rid of a lot more problems by letting somebody else fly the plane. What's left for you to do, and how do you do it well? Well, let me try to give you an idea about that. But I can tell you that it is 90% about data. And not just data, it's about information. We typically say when we're the administrator, you're only left with two responsibilities. You got to send information when it's needed and all kinds of information, and you got to send in the money. Your employees are deferring into the plan. Well, you got to send that into the plan on time. So you got to send contributions when they're owed, and you got to send information. So the data thing is where it goes wrong a lot. And I think there are a lot of misunderstandings about what you're able to do about it. So my last little picture here, there's a loop. All right, so from you to your payroll system, there's information that has to flow. So we have a new hire. You got to enter that in the payroll system. And that new hire is then going to be reported to the record keeper. And with the record keeper system, maybe they'll have an eligibility screening mechanism that'll say, oh, this is a new person. They must need an enrollment kit, and we'll send them the enrollment kit. And maybe that person then enrolls, and so there's information goes back to the employer saying that employee needs to defer 6% of pay, which in turn needs to go back into the system. And maybe the employer enters it, and maybe the payroll person says they'll do it. Maybe the payroll company is claiming they will do that. So one of the things that is going on in the industry today is this concept of this loop that we call 360-degree payroll integration, where it's all just done for you. Well, here's my experience with that. It's a great idea, and we like doing integration. We like at least doing the upload part, the 180-degree part, meaning the part that goes from here to here, or in reality from here to here. So this whole first part, let's automate that. Let's make it so you don't have to upload it. But here's the thing. Here's what happens. Right here, right at the record keeper level. We got this loop going. You got the information going in. The record keeper just wants your data in their system, and they want your contributions in their accounts. That's what they want. So they want to make that easy for you. So if there's a problem with the data, like you haven't supplied hours, or you haven't supplied a hire date, or the hire date is before the birth date, we see that one every now and then. The fields, you enter the data in the wrong field. What'll happen is there'll be an alert that'll pop up at the record keeper level, and it'll say, hey, you need to fix this. But they give you an easy button. They say, if you don't want to fix it, just hit this button. We'll accept it anyway. Well, what the integration does then, it just eternally perpetuates bad data. And the harm that is done there is that you think you're out. Hey, that salesperson told me I don't have to do anything. I'm out. You're not out. You really have to. You have to do a couple of things. You have to make sure that the data that has to be corrected gets corrected. You have to make sure that the new employees and the new information you have on employees gets into the system. And you need to make sure that any corrections that come back from the record keeper or the payroll system get into the system. If you're in that loop, you really can't be removed completely from the loop. You are the pilot for the payroll part of it, even though we're trying to put it on autopilot most of the time. And then the annual census verification, all those examples I gave, if you pay attention to that, if you're faithful about understanding that you can't get away from really giving good data on that annual census, you're going to be in great shape. So this combination of things to set yourselves up to win, having a smart plan design, hiring a professional independent administrator to take chores off of you, and as long as you remain a willing participant, you're not going to pilot the plane, but you've got a part of it left that you can't get away from, and you're comfortable doing it because so much has been removed from the plate. What's left is now achievable. That's what we like to get you down to. So last couple thoughts before I let you go. And incidentally, if you have questions, we are at the bottom of the our 30 minutes is up, but I am happy to stay and take questions. So there's a way to type that in. So if you go on your screen and you type in a question, I will go ahead and try to answer those. Who is PENTegra, for those of you who don't know us? We were founded as an independent administrator, as a fiduciary. So we were created to be responsible for this stuff. We weren't created to sell a product. We're not affiliated with a product vendor. We don't have our own stuff. We're a fee-for-service provider and a professional fiduciary. So our mindset for 75 years has been, how do we get this right? And how do we help our clients get their part of it right? We are one of the largest, most experienced 316 administrators in the US. And I think if you were to look at our contract, have a lawyer look at our contract to see what we actually accept legal responsibility for, you'd be impressed. You'd look at it and go, this is very different from the offerings that are out there in the industry. And we're proud of that. So, okay, we are, our time is up, and I appreciate everybody hanging in there with us. And I do have a couple of questions here, so I'm going to try to go through these. So other than the first couple of questions being, hey, Swisher, could you please share your screen? We got through that. Will we get the presentation deck? Yeah, that's going to be posted out there. So next question is, so do you do 316, 338, 321 fiduciary and investment advisor and payroll integration, all of those things? So those are a lot of questions. So 316 refers to being a professional administrator, and yes, we do that. One of our great things that we are known for. The term 338, 321, those are other ERISA terms, and they refer to professional investment advice or management. Yes, we do actually offer those things. We typically work in conjunction with a professional advisor. So that's our normal method of operation. But we have a trust company, and we have our historical client-based financial institutions where we typically serve as the trustee or the investment manager. We have a very large defined benefit plan where we are the investment manager. So there are a mix of roles that we can accept. And a couple more people asking if the presentation is being recorded and will be sent out with slides. Yes, it will. And so the next question is, so Pentegra would be the professional administrator? Yes, it is an option. We have the ability to do it with and without professional administration, where we're accepting legal responsibility, but that is kind of our claim to fame. And I do not have any other questions right now, and we are at the end of our time. So I am going to say thank you to everybody for joining us today, and I hope you have a wonderful weekend.